Hello, welcome back to International Finance. So, our last lesson, we looked at the balance of payments. We talked about the current and capital account, deficits and surpluses of trade and capital flows. We also talked about exchange rates. So we explained that if we have an increase in the exchange rate, all things held equal, our exports are going to become more expensive, so we expect less. Our imports are going to be cheaper, so we expect more. And then also it's going to have opposite effects on capital flows. So as exchange rates increase, we're going to see less capital outflow and more capital inflow, as foreign investors will be looking for markets that have price appreciation. And then we spent quite a bit of time to understand Brexit as a setting in which all of these things kind of break apart. This week, we're going to focus on the international monetary system. So we'll look at open versus fixed exchange rates, currency crisis, very different currency crises across the world. And hopefully that will allow us the ability to understand market efficiency within an international finance context. The key idea as we examine the international monetary system is that we want to provide a good, solid background on the current exchange rate system to understand how it operates between countries and how that affects both managers and investors. So let's jump right in. We've got our present value equation. Now, the international monetary system, the fact that we have different currencies, different fiscal and monetary policies, meaning that governments have different spending and tax policies, different interest rate policies, and also capital controls. Governments have differences in the way that they allow investment to flow in and out of the country, what's investable, what's not investable, what type of firm can be acquired, all of it. All of those differences across countries are really going to affect firm value. And there are three general ways that we'll think about those differences across countries affecting firm value. The first is if we look at our present value equation, is through our free cash flow. So our free cash flows, if they're unhedged, meaning that if we don't actually hedge out changes in the exchange rate, then clearly if we have a change in the exchange rate, it will affect the value of our revenues, cost of goods sold, and etc. And to be clear, we don't necessarily have to be an importer or an exporter to be affected by exchange rates. If we operate in an industry that faces high competition or an industry that is globally integrated, even if we don't necessarily import or export, we will be affected by a change in the exchange rate, as we talked about last week. Okay, the second way that this international monetary system is going to affect firm values through the cost of capital. And this can kind of happen in a couple different ways. The most direct and easy to understand way is that if our capital gains are unhedged, then the differences in exchange rates across countries will affect the cost of capital. The other way that this can affect the cost of capital is again through these capital controls and through monetary policy. So with the capital controls, if they're capital controls that limit the investability of our firm's stock or that restrict the accessibility of the debt that we want to issue to the global market, all of that is going to limit our investor base and, all things held equal, raise our cost of capital, because whenever we have a limited investor base, it's going to be harder for that investor group to diversify. And in exchange for not being able to diversify, they're going to require higher cost of capital from the firm. The last way in which all of this will affect firm value is through economic and political uncertainty. The key idea is that government's monetary policy, i.e. interest rate policies, fiscal policies, how they tax and spend, and those capital controls we just mentioned, the investment limits, all of that is going to impact Forex, firm decisions, investor decisions, and it's going to create a bit of uncertainty. So we'll delve into our later lectures how we can actually quantify that uncertainty. But the big idea is that whenever there is uncertainty, as a firm or as a manager, I might behave a bit more cautiously. As an investor, I might behave a bit more cautiously. So that caution is going to affect our decisions, and it's going to affect firm value. So let's kind of explain, what is an exchange rate? The exchange rate is the value of one country's currency relative to another. That is, it takes X USD to buy 1 pound, 1 euro, 1 yen, so forth. And these are symmetric. They're symmetric because we would always expect that $1 is not going to buy more than $1. So the cost of the dollar to pound should be symmetric for the cost of the pound to dollar. They should be inverse and symmetric. As of Jan 1, 2021, 1.367 USD equaled 1 pound, and 1.218 USD equaled 1 euro. Meaning, if I wanted to buy a pound, if I wanted to buy 1 pound, it would take me $1.367. If I wanted to buy 1 euro, it would take me $1.218 to buy 1 euro. Which currency seems strongest or has the highest price? Well, clearly, if we're looking through these three currencies, we would say it would be the pound. Why? Because it takes more dollars to buy 1 pound than it does to buy 1 euro. In both, when we look at the pound and the euro, we can see that it's going to take more than $1 to buy 1 unit of each. So clearly, they are stronger or higher priced relative to the dollar. We would expect 1 pound to buy more than 1 euro based on that logic. So let's work through to make sure we understand. So how much does $1 cost? First, we're given the price of the dollar to the pound. So we can then infer the value of the pound to buy $1. What do? We just do some division. So we take our 1.367, we divide it by both sides. What is that telling me? That's going to tell me the price, how much it's going to cost me to get $1. So we can see that 0.732 pounds is the price of $1. Let's do the euro. Same logic applies. We do the same steps, and what do we find? We find that it takes 0.821 euros to buy $1. Okay, what is the price of pounds in euros, or 1 pound buys how many euros? In order to solve this, we're going to set our dollars equal to each other. We know that it takes 0.732 pounds to buy $1, and we know that it takes 0.821 euros to buy $1. So we set them equal to each other, and then we solve. And what did we find? We found that 1 pound equaled 1.122 euros. And just to make sure that you're on the same page and that you're following along, take a moment and go ahead and Google what the exchange rate was between the pound and the euro on Jan 1, 2021. And that's exactly what you'll find. So the key point is that these are going to be symmetric. And the reason why these are always going to be symmetric, or generally are going to be symmetric, is because there's going to be limited arbitrage. When these prices deviate from one another, investors are going to quickly jump to push the prices back closer together. So we'll look at this kind of more in depth. But for now, what does this actually look like? So this is the trade weighted value of the dollar from 1964 to 2020. What am I showing you? I'm showing you the value of the dollar relative to the trade partners that we have in the United States. And what do you see? Hopefully, what you can clearly see is that through time, the value of the dollar, the trade weighted value of the dollar, the relative value of the dollar relative to the actual import and export partners has changed quite a bit through time. You can see there are periods where it's high, and you can see there's periods when it's low, like during the global financial crisis. You can see during the tech boom, it's fairly high. So the point is that there is a lot of change that happens when we look at the value of the dollar through time. So let's understand a bit of the history of the system. So the international monetary system has gone through numerous changes. It was pegged, meaning that the currency would trade at a fixed range relative to a specific value. Before 1875, it was pegged to gold and silver. This is the bimetallism area. Then it was on a gold standard from 1875 to 1914, basically pegged to gold. We have the interwar period. So this is 1915 to 1944. This was a period of high economic and political instability, lots of financial panics. Bank runs, you can think of a financial panic as akin to a bank run across countries. And then also predatory devaluation for exports. So countries would devalue their currency as a mean of increasing exports and reducing imports. That devaluation, as we discussed before, led to a lot of capital flight, meaning that foreign investors would take their capital and run. So just like a bank run, just like a financial panic, but it's within the context of foreign investment. After the interwar period, we had the Bretton Woods system. We had the dollar pegged to gold. Currencies were pegged to the dollar. That broke down in 1971, 72, when the US went off the gold standard, and now we have flexible exchange rates. So we'll look at these periods to kind of understand a bit of how we got here. So the gold standard in the interwar period, the gold standard was from 1875 to 1914. How does the peg work? The reason why I think it's helpful to kind of understand this is because, again, if you're not used to thinking about exchange rates or to thinking about international finance, sometimes it kind of helps to have a concrete example. So what do we have? For example, suppose that $30 bought 1 ounce of gold, and suppose that 6 pounds bought 1 ounce of gold. Just like we started when we looked at the relative price of the pound and the euro relative to the dollar. Here, when we had the gold standard, instead of putting everything in dollars to equate them, we would look at their relative price of gold. So as you can clearly see and do the math, if we've got $30 equal to 1 ounce of gold equal to 6 pounds, then implicitly we have $5 equal to 1 pound. So using gold for international payments made a persistent trade deficit or surplus virtually impossible. If you think back to our balance of payments lecture, we said that when there's a persistent outflow from exports, so if you're selling your goods to the world, then there's going to be an inflow from the world paying for those goods. Well, when the method of payment is gold, that outflow for exports is going to send back an inflow of gold. And as we just saw when we were looking at this pegged example, if you have more and more gold, then the value of your currency is going to go up. If your currency goes up, it becomes even more expensive for you to export. That's what we worked on last week. And you can imagine the opposite. If I'm importing a ton of goods, then I'm sending gold out of the country. So as we import and buy more and more goods that are produced abroad, we send gold to pay for those goods. As we send gold out of the country, the value of the currency falls and it becomes harder to import because those items that we're importing now become more expensive. So the idea is that when you have this gold for international payments, it makes it really difficult to have a persistent trade deficit or surplus. The system would eventually fall apart as international coordination shut down during the interwar period. In order for this system to work, you have to have countries that are all coordinating and on agreement in terms of the method of payment and in terms of their currency policies. So once we had currency devaluation become tied to different economic and political goals during the interwar period, the gold standard just went away. It was not successful. So after that, we have the Bretton Woods system. And what's the idea behind the Bretton Woods system? The idea behind the Bretton Woods system is that we peg the dollar to gold and then peg currencies to the dollar. So the goal is to stabilize exchange rates without relying on the flow of gold between countries. And in order to help facilitate that, during this period, we have the IMF and the World Bank basically be created and implemented to help the world. So USD serves as the reserve currency, and this works incredibly well until gold demand rises. Now, if you look at this time period from 1945 to 1972, that's quite a span. So over this period, nations are recovering from the world wars, their imports are increasing, their repayment demands, they're rebuilding. So basically, there's becoming more and more gold demand. So why does the system collapse? The system collapsed because of this idea known as the Triffin paradox. And essentially, there will be a conflict of interest between the US and the world. The main idea is that the dollar to gold exchange rate is essentially doomed from the start. In order to supply the world with dollars, because again, that's the reserve currency, the US is going to run a balance of payments deficit. So we talked about that last week, and we'll look at examples in this lecture to kind of keep that idea fresh in our minds. That balance of payment deficit, meaning that we import a lot, we buy up a whole bunch of goods and send our dollars to the world. The world holds on to those dollars as a way of having reserve currency, as opposed to using gold to have reserves. So because we do that, those deficits are going to lead the market to kind of lose faith in the dollar as a reserve currency. Well, why? Because you can only finance that behavior if you're kind of borrowing. So as the dollar falls in value, nations are going to want to redeem dollars for gold. And as they do that, it becomes harder and harder for the US to continue to serve as this global reserve. So this whole system kind of breaks down, and essentially the US abandons the gold standard in 1971. And once that happened, eventually we kind of reached the current system, which is a system of flexible exchange rates. So from 1973 onward, gold is no longer the explicit reserve currency, and central banks are able to intervene in the forex market to keep exchange rates relatively stable.